Hello and welcome to another edition of Capital Market live on Channels Television. I'm Ladi Williams right here in Lagos. First off, let's look at how your money performed during the week. Start off in Europe where stocks closed lower after another volatile session on Friday, wrapping up a tumultuous week following renewed concerns about the Omicron COVID-19 variant. Continues to weigh on the market while investors reacted to key U.S. inflation data. The FTSE 100 fell by 0.4%. The German DAX declined by 0.1%, while the French CAC 40 dropped 0.24% lower to close on Friday. Markets have been reacting throughout the past couple of weeks to comments and research into the transmissibility and severity of the new Omicron variant, with a number of major economies now implementing tighter containment measures. While the final German consumer price index inflation was confirmed at 0.2% month-on-month in November for a 5.2 annual decline. And in Asia now, Asia-Pacific markets declined on Fridays as investors assess risk associated with the new Omicron COVID variant and look ahead to key inflation data. And in Hong Kong, Hang Seng Index fell 1.07% to 23,995 points. Benchmark indexes in Singapore and India traded lower in the afternoon of Friday, and Asia follows overnight declines on Wall Street. Japan's Nikkei 225 extended losses from the previous session and declined 1% to 28,437 points. The Topix index fell 0.77% to 1,975 points. And the S&P 500 closed at a record high on Friday, capping off Wall Street's strong rally this week, despite inflation hitting a 39-year high. The S&P 500 closed 0.95% at 4,712. The 500 stock average sits 0.7% from its all-time high, while the Dow Jones Industrial Average gained 216 points to about 35,970. The technology-focused NASDAQ composite climbed 0.7% to 15,630 points. The Dow Jones Industrial Average rose 4% since Monday, snapping a 4-week losing streak. The stock index had its best weekly performance since March, while the S&P 500 and NASDAQ composite added 3.8 and 3.6% respectively this week, the best since February for both indexes. Inflation soared 6.8% year-on-year in November to highest rate since about 1982. The Labor Department said the print came in slightly higher than the 6.7% Dow Jones estimate. The Consumer Price Index, which measures the cost of a wide range of basket of goods, rose 0.8% for the month. And back home, the trading week ended Friday, December 10th. Stocks listed on the Nigerian exchange lost about 150 billion naira amid mixed trading session of losses and gains. The week closed with 3 days of gains and 2 days of losses. Stock market was down by about 0.68% in the review week, largely driven by sell pressure in industrial stocks. The Nigerian Exchange Limited Industrial Index was the sole laggards in the week. The Nigerian Exchange Limited All-Share Index and market capitalization, which opened the week at 42,167 points and 22 trillion respectively, stood lower at 41,882 points and 21.85 trillion at the close of trading on Friday, December 10th. The record positive close of 0.47% Friday pushed the equities market positive to return higher to 4% year-to-date. Other key performance indices closed the week in green. The NGX Banking Index, about 5%. Consumer Goods Index, up about 0.11% in the week. Oil and gas, 1.27%. And Insurance Index added about 1.24%. Meanwhile, activities at the unlisted securities market closed negative this week as both the NESD OTC Security Index and the market cap decreased. Same time, NESD investors lost about 10 billion naira. The market capitalization closed at 604.88 billion naira this week. Total volume of securities traded decreased by about 71% to 6.57 million units of shares traded. Central Securities Clearing System PLC and Friesland Campina WAMCO were among the top 5 traded by volume. Also, Central Securities Clearing System PLC occupied the top spot on the gainers chart. Meanwhile, stocks of Friesland Campina WAMCO Nigeria topped the decliners counter for the week. All right, now for a review, now we have our guest today joining us right there in Abuja, Professor Uche Waleke, Professor of Capital Market, Nasarawa State University, and the President, Association Capital Market Academics of Nigeria. Welcome to the program. Thank you for joining us.
Thank you very much, Ladi. It's my pleasure.
Yeah, so let's begin with a review of the stock market performance. About this time last year, the market was trending upwards, but it seems we're having the reverse right now.
Well, for the month of December, yes, because last week the market lost 2.65%, and this week, week on week, we are also witnessing a loss of 0.68%, largely on account of the drop in industrial stocks. Of course, you know, the bellwether stock there is, Dangote Cement. Dangote Cement went down from 280 naira to 252, naira as we speak. Of course, that dragged down the performance of the market, and we saw that huge loss, on Thursday. But that's not to say that, we have not witnessed some sort of improvement. This week is a clear improvement over what we saw last week. Last week was complete 5 days, 5 days of trading losses, as opposed to this week. At least we had 3 days gains and 2 days of losses. And if you also look at it in terms of market sentiment, measured by the market breadth, we had 23 gainers as against 13 losers, and the majority of the sub-indexes gained. The oil and gas, NGX oil and gas, NGX insurance, NGX consumer goods, and NGX banking, they all gained. It was the industrial stocks, the industrial index that actually pulled down the market. But overall, yes, your observation is very correct. Last year, this time, the market was actually, on a bullish note. But this time around, we haven't seen that kind of traction. And what, in my view, was largely responsible for what we saw last year was, if you recall, by September of last year, the central bank, had reduced the monetary policy rate by 100 basis points from 13.5 to from 12.5 to 11.5, where it currently is. And we saw rafts of interventions. We saw a lot of money coming into the system by the government and the central bank, all in a bid to curb, to curtail the negative impact of COVID-19. So all of that injected liquidity into the system and crashed interest rates. So we saw fixed income, returns from fixed income securities going down, and of course, a rebalancing, or if you like, rebalancing of securities in favor of equities market. So that's principally what caused the bullish nature of the market towards the end of last year. Of course, that is not the situation we have, we have today. Interest rates are beginning to go up, and of course, what is happening now is simply profit taking. The usual thing you expect during festive seasons when investors, try to prefer. We say this time around, this liquidity preference is in favor of cash. So people want to hold cash because they want to spend around, festive period.
Right. All right, Professor. But looking at the uncertainties, with the Omicron variant right now rocking the other markets in the world, how do you see this, impacting Nigeria's capital market going forward?
Yes, for now, I don't see any immediate worry. You also realize that this time last year, in 2020, we had COVID. And despite the COVID, the Nigerian stock market emerged the best in the world. returning over 50%, compared to what markets across the world, did. Over 90 exchanges, that were monitored. So I don't see that as a major concern, for us now. What's important is that, the companies that are listed, have good thefundamentals, going by the results being released, and even going by the earnings forecast. We are beginning to see companies, make their earnings forecast. So to the extent that these forecasts are still, to the extent that they look good, I don't see that much threat from the Omicron virus affecting our market. As long as the government doesn't again use those panic measures we saw in 2020, as long as we don't have restrictions, as long as we don't have lockdowns, as long as the economy continues to be up and running, I don't see those threats manifesting, at least in the near term.
Right, we don't want to hear the scary words. That's a lockdown. But the primary segment of the market has been quite dormant for a while now, with little or no IPOs in market. How do you think this situation can be improved going forward?
Yes, the drought we have in the IPO primary segment of the market has also to do with the macroeconomy. You find companies tell you that they won't come to the market except the market conditions are right. So it is the macro economy too that is partly contributing. The other two has to do with the secondary market activity. For any primary market activity to succeed, you should have an increased tempo of activities in the secondary markets, because that's also an indication of market sentiment. You wouldn't want to go to be issuing shares when the market is dull, or when you have a bearish market, because you risk not getting all the funds you are looking for, and you also risk having a very high cost of raising the money in terms of underwriting costs. So when you have a situation in which the secondary market is bullish, is booming, considerable activity in the secondary market, that will encourage, incentivize companies to come to the market, knowing full well that doing so will establish some level of success. Now, the other thing I want to say regarding boosting the primary segment of the market is that the government has a role to play too, by incentivizing companies to list on the exchange, because we need to have enough supply of securities for the market to have depth and breadth, if you like. So government can do so by using some fiscal incentives. I've always said nothing stops the government, for example, from having a tiered corporate tax structure that is in favor of companies that are listed on the exchange. If you say, for example, companies' income tax today is 30% for big companies, if you say listed companies should pay 28% tax, that's a form of encouragement. Or you also use tax break or tax holidays by which you give any company that is listing 1 year or tax break or tax holiday. That's also an incentive. That way you have more companies come to list, and as they list as they're also listing, they're also doing an IPO. I'm not just talking about listing by introduction, but coming to list and then of course issuing shares either as IPO, and the existing ones can also do a follow-on or offer for subscription. If you like. That is when the market, because the primary segment is actually the real thing about capital market. Capital formation is defined by primary market activity and not necessarily secondary market activity.
So, Professor, you see, on this MTN offer, it's being marketed pretty strongly. Can I get your thought on this current offer? How is it different from an IPO?
Okay, the MTN offer is not an IPO. IPO is initial public offering. What MTN is doing, MTN Nigeria is doing is offer for sale. in an offer for sale, a major investor, as the MTN International, incorporated in Mauritius, is offering, selling part of its shares. We understand about 575 million shares. Of course, it's part of a program. It's a shelf program. Shelf in the sense that it's been already approved. They intend over time to sell as much as 2.8 billion shares over a period of time. It may interest you to note that if you check the outstanding shares of MTN Nigeria is in the region of 20 billion shares. So they want to do 2.8, starting with the 575 million offer for sale. A friend told me that when I asked him, he said he's buying the MTN shares because MTN is investing in, going to use the money to invest in 5G, and he thinks that will increase the price of share price of MTN, in the near term. And it's important that investors understand that this is not an offer for subscription, it's not an IPO, it's an offer for sale. The money is not going to MTN Nigeria. The money is going to the investors. The share capital of MTN Nigeria is not going to increase. It's only part of what is already in existence that is being sold. I think that is important, that is communicated to the investors. But it's also important to note that return on investment has two components. First is the share price. People think in terms of capital appreciation. They want to buy today and then sell tomorrow at a higher price. But there is also the dividend component, which to me is very, very important in a capital market transaction. So anybody doing shares should have a longer term perspectives. And for me, with respect to the MTN offer, longer term perspective is will be very, very rewarding, given that this is a company that has a track record of dividend payments. Last year they paid 7 naira 90 kobo. 2020 that they did something higher, 9 naira 40 kobo. So a company with this track record of dividend payment and with strong fundamentals is good to take a position in terms of long term, but not people shouldn't go into it from a short term perspective. Remember, this stock was some point last week fell to 167. It's being sold now it's being sold to retail investors at 169. At some point it was 167, but today, as of Friday, the share price went up to 174.5. So without really being part of marketing for MTN, I want to say that it's a good investment, especially in the long haul.
Okay, but looking at this style now, do you see more companies actually coming to the market with the same strategy?
Yes, I think it will. Offer for sale, as I mentioned, has to do with you have a major investor trying to sell part of what he or she has in the company. But I want to see a situation in which going forward, the market will welcome more of offer for subscription, more of IPOs. Because if a company is doing an offer for subscription, the money comes to the company. That is when you talk about expansion, and the share capital of the company will also increase. This is a case of a holding company, trying to increase the free float, as it were, of the shares of that company. They want to move from 21.2% free float to 35%, free float over time. So, in other words, they want to accommodate more retail investors and dilute control, so to speak. But the kind of activity I would like to see in our market today will be more of the one, as I said earlier on, that's emphasizing capital formation. Companies issuing shares because they want to raise funds to be able to expand, and that will create more employment, in the system, and it's a positive for economic growth.
Okay, all right. Let's look at the launch of the NG clearing now. So, talking about infrastructure, what is the likely impact of this, recently launched NGX clearing on the market?
Let me start by congratulating the Nigerian Exchange Limited. As a matter of fact, the entire group, on the launch of the NGX, clearing. The NGX prides itself as, one entity that is leading, in Africa in terms of market integrated. I think that's the word, integrated market infrastructure, and that is where the NGX clearing, comes in. You recall, Ladi, that sometime in June, the Securities and Exchange Commission, approved about seven. I think there were seven derivative contracts for the Nigerian exchange. I remember that of Zenith stock futures, GT stock futures, MTN, seven of them. Okay. Now, for that to take off, for derivative trading to take off, you need a clearing house. You need a clearing facility. So the NGS clearing is nothing but what we call a central, counterparty clearing house. A counterparty is the party on the other side of the transaction. So what it does is to interpose itself between the parties, as we say in finance balance, as a buyer to every seller and a seller to every buyer. That way the risk is minimized. So it's meant to facilitate exchange-traded derivatives. It's meant to minimize counterparty risk, and of course bring about efficiency in derivative trading. And for me, it's a very good development that we are having that in place. I understand it's the first in West Africa, and so what that does is to help to deepen the market. Recently at the NGX conference that I held in Abuja, I was in attendance. The Vice President, Yemi Oshibanjo, talked about the need to reduce the volatility in our markets, and one way you can reduce volatility is to have derivative products, financial derivative products that investors can use to hedge. So you have new asset classes that pension funds, for example, institutional investors find them attractive. They can use that to hedge the risks of investing in the market. So it's a good development. And with that infrastructure in place, you can be sure that derivative trading will be facilitated in our market. One of the things we often say about our market is that compared to South Africa, we don't have sufficient, if you like, asset class or sufficient product. But with what has happened now, with the approval by SEC, or with the licensing of this derivative contract, and with the infrastructure that is in place for trading of exchange derivatives, I think that is one positive thing that has happened to the Nigerian capital market. Of course, the CSCS has been there for the equity segment of the markets, owned by the Nigerian Exchange. And now we have the NGS Clearing Limited, which, as I said earlier on, is a wonderful development for the market. Right.
All right, Professor, I want to thank you so much. We'll see how the market actually plays out for the remainder of 2021. Thank you so much for coming on the program, Professor Uche Waleke, Professor of Capital Markets, right there in our Abuja studio. Thank you so much.
Thank you very much, Ladi.
All right, and that's a wrap on Capital Market this evening. Thank you so much for watching. I'm Ladi Williams. Bye for now.